Hi, I'm Pattu from freefincal. In this video, let's take a look at long-term equity investing and ask the question, does it really work? Because the mutual fund industry will always tell you that the best way to build wealth is via SIP and equity mutual fund over the long term. But where is the proof that it will always work? And we are going to look at 110 years of the S&P 500 and 40 plus years of the Sensex data to find out if there's any truth to this claim. Now, to define what works and what does not work, we will first define long term as 15 years. And that's a pretty good duration, is well above what the mutual fund industry typically defines as long term. And we will define a success, that is a long term SIP, as successful if it produces a return greater than the consumer price inflation of that country, whether it is US when we compare S&P 500 or India when we compare Sensex. Of course, this is not a realistic, you know, manifestation of day-to-day ground level inflation, because real inflation for our households will incorporate a huge amount of lifestyle creep, lifestyle change that does not get captured in the CPI inflation. But if the equity SIP return comfortably beats this CPI return number, typically, then I think we are reasonably okay. Now, it's very important to understand that there is no obligation for the equity market to give you the return that you expect. You may expect 15% return, 17% return, and so on, looking at what happened in the last couple of years. But over the long term, equity does not have to produce those kind of returns for you. So, if you expect, let's say, 15% returns, and the long-term inflation in India is only, let's say, 7-8%, and uh, over the next 15 years, the SIP gave you like 10% before tax, and after tax 9%. The equity SIP has won. The equity as an asset class has won, but you as an investor has lost, because you expected 15%, 12%, 13%, 14%, but the market only gave you after tax 9%, which means that you invested less anticipating higher returns, and you can't go back and invest more, because that whatever time is lost forever. So you have to appreciate these factors. Now, to look at the source of the data, all the links are there, the references are there in the main article, which I'll put in the description. If you want to create such rolling SIP return charts, you can always use the tools in our freefincal investor circle. So we'll first start with the um, S&P 500 return. Now that there are about 1329 blue dots in that curve, and each of them is a 15-year SIP XIRR, that is the annualized return, and the red dots represent the 15-year US consumer price inflation average. And you can see, first of all, you can see how cyclic the returns are. The returns move up and down, move up and down. You can't expect anything. See, if somebody says, oh, I will do a SIP over 15 years in the S&P 500, that they call it dollar cost averaging. If I do that, how much return will I expect? The answer is I don't know. The truthful answer is nobody knows. If somebody says you can expect 10%, 12%, they are just speaking through their hat. The truth is, this is the data, and you don't know. It can be anything. It can be as high as 20%. It can be as low as 0%. In fact, some data, some of those 0% data is actually data which cannot be calculated. They are actually less than zero, one or two data points. So it can be anything. So, and the second most important point, and I keep saying this because everybody seems to be taking a rolling return data and taking the average. How can you take an average of a sine curve? This is basically like a sine curve. It goes up and comes down, goes up and comes down. You can't take the average. That's silly. I mean, it makes absolutely no sense. You should know when to take an average. Knowing how to take the average is not important. Uh, of course, yes, the data tells you typically the XIRR has been comfortably above the 15-year inflation average. And that's a good news. This means that long-term equity investing has a reasonable chance of success. It does not have a guarantee, You don't know how much return you're going to get, but there's a reasonable chance of beating inflation, not your expectation. If your expectation is well above inflation, then you can't expect success all the time. Then the higher your return expectation, the more will be the chance of failure. Because if you put for example, if you draw a line above the red dots, that is, let's say that's your expectation, then the number of blue dots below that line will be more. As you increase the line above and above, farther and farther away from the red dots, the number of blue dots that will fall below the line will become more and more. So that means the chances of failure increases when your expectations increase. So, like always, like all our philosophers say, like all our what the Bhagavad Gita says, uh, work without expectations, invest without expectations, keep your expectations, if any, low. Because of course you need some expectation to do a financial planning, but keep those expectations reasonably low. I would suggest expecting no more than 9 to 10% from a equity SIP returns. People say, oh, no, if I want to expect only 9 to 10%, then why should I invest in SIP? I will equity. Why should I can invest in fixed income? I am talking about 9 to 10% after 15 years. After 15 years, I expect the inflation to be a little more lower. If you are going to get 9 to 10% from fixed income after 15 years, that means the country is in trouble. That means the inflation is high, the rupee is devalued. So be careful what you expect. And it's a very, very safe estimate to expect 9 to 10% for two reasons. One is you will push yourself to invest more if you expect less. And the second point is, even if you get 11%, even if you get 10.5% after or 10% after tax as a from equity, you will feel happy, you will feel comfortable, you will feel as if you have done the right choice by putting so much money in equity. So that is the reason why I say keep your expectations low. You can drive your wealth uh, higher up. Now, please recognize that this is a huge amount of data. This is like 110 years. Actually, the data is much more. The data is available from 1879, 1875 or so. Excel cannot handle dates before 1900. That is before 18 in the 1800s and all that, can't handle data. So I can't plot the data. I have left out 35, 37 years of data from this chart. So this kind of luxury of huge data to get such kind of insights is not available with the Sensex. The Sensex only gives you 40, 45 years data, and it has actually, some of the data is actually back tested. The actual data, the traded data is much less. It's only from 86 onwards we have traded data, if I'm not wrong. Now, if you see the dots on the dots which move up and down like this, those are the 15-year rolling SIP data from the Sensex price information. I have added 2% for dividends because real return data is not available all the way since inception. This is a problem in our country. Availability of data is very difficult. History is low. History is less. Availability is also difficult. So that's a double problem when it comes to doing open-minded analysis. The 15-year consumer price average is shown as the crosses. The crosses are the 15-year CPI inflation average. If you notice the 15-year PPF interest rate, the green dots, the light green dots, they've been above the CPI inflation number. I think it is a very fair estimate to say that the PPF return is a very good representation of actual realistic inflation in India for our households. And of course, typically the Sensex has beaten that PPF interest rate, not always, typically, but we do not have enough data to observe cyclic behavior. Look at the kind of returns that you saw in the 90s for people who started investing in the 70s and so on. The kind of returns that they saw from the return, that's like that 25%, 30%, that returns are no longer available as of now. The current return is like 12%, 13%, 14%, something like that. But that doesn't mean that such a period won't come back. We don't know. The future is unknown, but it is always better to expect less. So this is why I keep saying Equity investing does not come with a guarantee, but if you give it enough time, there is a reasonable chance. People say, why should I invest if there are no guarantees? That's a silly thing to say. Whatever you do in life does not have any guarantees. You put a kid in school, there's no guarantee he will finish the schooling. If you put a kid in college, there's no guarantee he will finish the college graduation, come out with the college degree. Yeah, there's no guarantee he will get a job. Even if he gets a job, there's no guarantee he will stay in the job. If he gets married, there's no guarantee the marriage will work. You have to work. You join a school, join a college, enter into a marriage, you have to work on those things for them to work. Similarly, you have to work on your portfolio. You have to work on your investment management, risk management, excuse me, to actually make it work for you. You can't simply say, I've started an SIP, my work is done. All I will now do is every lunchtime I will open the app and look at the market values. That is silly. You must have a proper goal-based approach. You must have a proper asset allocation, and you must ask yourself once a year, how am I doing with respect to my goal targets? Am I reaching my goal targets in the right pace? Am I expected to, be successful in having enough money in future to achieve my goals, etc. So those kind of personalized planning, personalized portfolio management is what makes a person successful. So you can't simply rely on equity investing, and more importantly, you can't simply take what the mutual fund industry says too seriously. Of course, they will say, this is great, put it inside, but they will never tell you that I mean, there's no guarantee. Of course, they'll put it in the fine print, but at the advertising, they will not tell you, and they won't show you this kind of up and down SIP return. So you must be aware, and make prudent decisions about how you invest. And most importantly, I would say, expect less and push yourself to invest more and more every month, or at least every year. That is the key driver of wealth. So this is what I mean by I call as an expectation gap. That is, you expect some high return, but you get something low. This is different from what people call as the behavior gap. Behavior gap means the asset class does well, but the investor does not do well because of their poor behavior. They'll sell in panic and they're not investing all the time and so on. This is a slightly different kind of gap, which I would like to call as the expectation gap. So have the right expectations. That's what's always important. If you notice, people always ask in the comments, I'm investing in these funds. Can I invest? Is this the right choice? Nobody knows what the right choice is. You must have the conviction to start investing and the courage to change your mind if things go bad. Then you must have the courage to switch funds or whatever. But you must do it all by yourself, and there's no place for regret. You took a choice, you made a choice, it didn't work out, so you just switched. So you can't ask for something that is foolproof, that will work for the next 15 years, 20 years. Nobody can give you that guarantee. So please create a personalized plan with appropriate expectation and risk awareness. Thank you. Bye bye.